morning. This is Gail Leverson. I am an MBA candidate at Bemidji State University, and this is my final presentation for my strategy and management course, the capstone course in my MBA. The name of my company is Happy Feet Shoes. Give you a basic introduction of the game that we're playing. It's called the Business Strategy Game. BSU uses the Business Strategy Game as the capstone course for the MBA program. The Business Strategy Game is called the BSG, and it was developed in 1990 by two authors named Thompson and also by Greg Stappenbach. Three other authors, Mark Reidenbach, Chris Harms, and Ira Thrasher, joined later on. They update the game every couple of years, so it stays vital and complex. And it is really a virtual company that we run for an entire course to see what the opportunity and the complexity and the rivalry is really like in business. In the BSG game, each week is equal to 1 year of business life. The students study the industry and study their companies, ratios and market and standing each week. And at the end of the week, we make a decision round. That's all of our decisions for the whole year. BSG calculates the decisions at the end of the week, and they rank our companies. And the companies with the strongest strategies will always score higher in the BSG game. There are 5 key indicators that the board of directors would like us to focus on in our companies. So our earnings per share should increase by 7% each year. Our stock price should also increase by 7% each year. Our return on equity should be at 15% or higher. Our credit rating should stay at B+ or higher each year. And our image rating should be a 70 or higher each year. An image rating is the rating that people out in the world think of your company. It is based on the quality of your product. It's based on the celebrities that endorse your product and just your whole corporate social responsibility reputation in the world. So BSG runs the companies from 0 to 10. And when we start working with the companies, all of our companies start with the same rankings and the same financial resources. And our students in the MBA capstone class run the companies from years 11 through 15. So we have 5 years of our competition. There were 4 people in our class, and so each of us ran our own companies, and so there were 4 rivals in the industry during this 5-year competition, and we actually got to be very good friends throughout the competition. The problem statement, as I see it, was my strategy. We set up our strategy before we started the game, and I set up the strategy of a low-cost provider striving for overall lower cost than the rivals for a comparable product. And I had read that that was a good strategy to use if you only had one use for your product, which is shoes, so we only have one use for it. And based on that, I thought, okay, that's a good strategy, but I found that it was a middle-of-the-road strategy, and the farther we got through the competition, the farther that I could see that I was off from being the leader in the competition because I didn't make a strong, grandiose strategy. So my middle-of-the-road strategy of low cost and comparable product did not provide the momentum needed for Happy Feet Shoes to gain and keep the market share. We started out with the higher sales. We actually were ranked #1 in 3 of our 5 weeks. But as the competition went on, in the last week we lost a lot of market share, and that's because one rival entered the market with a vastly different strategy. So that's something I'll always remember, is to create a strong strategy, something to strive for. I did a SWOT analysis in year 13, and you might want to know why I did it in year 13 instead of the end. But I thought it was important to do it then because I could still make changes in my strategy or still make changes in the design of my company. But we also had 3 years under our belt at the time I did the SWOT analysis. So SWOT means strengths, weaknesses, opportunities, and threats. And strengths and weaknesses usually refer to the internal running of the company, while opportunities and threats usually refer to the external part of running the company. The strengths of our Happy Feet shoes in year 13 was the experience of the owner. I was on top, in first place, both of the first years, years 11 and years 12, and I was feeling pretty good. So the successful celebrity endorsement the first year, I found that celebrity endorsements are really important to selling a product like shoes where people can't really see the quality and the performance of it. So we competed for celebrity endorsements every year, and I was successful the first year. And so that pushed me forward quicker than my rivals. I had a first place ranking for 2 years, and then I tied for first place for a third year. So, like I said, it was feeling pretty good at that point. I had given stable dividend payments to my board of directors, which I thought would probably help in the image rating, and I'm not sure if it did though. We had the highest operating profit in our European and African markets and our Asian and Pacific markets. And those are sales markets, so that tells me that I should be concentrating on selling more in those two market regions. I had the lowest labor rates in the North American production plant. We were the industry leader in best practices, and I had invested the maximum in best practices, by the way, because I thought it was good for the company. And we also had the economies of scale because we had very low administration, low marketing expenses, and low warehousing expenses as compared to the net sales of Happy Feet shoes. The weaknesses of our company were I had lower than average cash on hand at that point. And I think it's probably because I made the celebrity investments, and I also made the best practices investments at the maximum amount for 3 years. Our image rating was a little less than expected. It was at 68, and it was stubbornly at 68 for the first 3 years, and we wanted to hit 70. I had relatively high reject rates when I compared it to the rivals. My wholesale market had been decreasing, not very much, but it was a signal that I should maybe do something a little different. The operating profit had been decreasing also. There's only so much you can save by being really efficient in the office. Eventually you have to increase your product market. My middle of the road strategy was weak. I felt that myself personally was a little weak on the exchange rate calculation, so I was depending on the BSG game to come up with those calculations, and sometimes I wouldn't really see those until the end. The expanded global capacity and the inability to keep up with the market share without expanding might be a weakness in the future, and I felt that I was a little shy at spending money because I had the lower than average cash on hand in year 3. The high tariffs and exchange rates in Latin America were a concern because I had no production facility there. Happy Feet Shoes had to import everything into Latin America, and it was expensive. See, the opportunities. I thought I had a lot of opportunity yet to grab more market share, to add manufacturing capacity, and in the game, we could start new facilities or add onto the efficiencies of our manufacturing capacity at our existing facilities by investing more. But I was a little shy to do that, and especially because it was only a 5-year game process, and I didn't know if I would see the results of a big-time investment in only a 5-year term. A lot of times the BSG games will go through a whole course instead of just 5 weeks. So that's just a little inside information. I had the opportunity to increase the efficiency of the manufacturing capacity with upgrades. And I had the opportunity to borrow more money to expand because I had a good track record at that time. The knowledge of my rivals, and I understood the reports well enough to focus on their market weaknesses. And I had some growth potential with being able to decrease delivery times or add free shipping to our internet sales. And none of our rivals had decided to do that at that point. So that was absolutely a growth opportunity. I could increase my corporate social responsibility investments, and that I ended up doing that, and it did have a good result on our image rating. And the global market for athletic footwear in the big picture was continuing to grow, and so we had good industry growth potential. The threats to my company of Happy Feet Shoes was that a rival could quickly gain strength in this very competitive industry, You know, I could see the standings would change every week pretty quickly, especially because there's only 4 of us, and we had a lot of um, effect on the marketplace. Financial difficulties could constrain my growth. The short 5-week BSG cycle offered limited time for long-term investments. So I already explained that a little bit with my thinking with not expanding. The global economy could collapse. We've all been there before. The rivals could increase their capacity and grow faster than Happy Feet Shoes. And so that has the effect of limiting my market share. The internet segment kind of rivaled the wholesale segment, which we both sold over. So the internet segment could eventually outsell the wholesale regions, which really were the bread and butter of the business. And so I had to watch that carefully. My internet segments tend to increase in sales faster than my wholesale regions did. The tariff and exchange rates could fluctuate, changing my profit margin. There would be increased competition for celebrity endorsements in the future. Like I said, I got that first endorsement. I was pretty proud of myself because that was a low bid, but that was only because it was the first round. And we could have more rival competition with slowing projected markets. The overall industry for footwear sales was supposed to be strong for the first 5 years and then go weaker after that, but we ended up after 5 years. So let's see. The financial analysis of Happy Feet Shoes after we were done with the competition, this would be our 5 years, and these are the 5 key expectations the board of directors had. Now the earnings per share was projected to be 7% per year, so it should have been at 3.5 after 5 years. Actually, it was 5.12. The stock price was projected to be at 42.8 cents per share after 5 years, assuming the 7% growth each year. Actually, Happy Feet Shoes had stock prices at 63.71. The return on equity was expected to be 15% each year, and our return on equity after 5 years of business was 17.9%. My credit rating was A, and it was projected to be B plus or higher, so we did well on that. In the image rating, I was able to get it from that stubborn 68 up to 73 by the end of the 5-year competition. And so we actually exceeded expectations in all 5 of the key areas of the financial analysis. And for that, I feel good about. And specifically, our financial performance in the earnings per share, you can see how we started out a little bit higher than the industry average. And the industry average actually includes all 4 of us, so it's me and the 3 rivals. But I was above the industry average on year 11, year 12, year 13, and year 14, but it was getting pretty tight. And by 15, I had fallen back just a little bit to be behind the industry average. And let's see, in my financial performance in the return on equity was, I started out Happy Feet Shoes had quite a big gap between the industry average and our company. After year 11, I had 18.9 and the industry average was 13.63. Everybody was still learning the game. And that kept on, let's see, I was above the industry average in years 11, years 12, years 13, years 14. And then you see in year 15 was the only year that I fell back behind the industry average. And that was mainly because one of the rivals was just went really fast and did really, really well the last year. And so it changed the industry average calculations quite a bit. The financial performance in stock price. Again, you can see by the bar graph that Happy Feet was above the industry average in years 11, 12, 13, 14, boom, 15, we got behind the industry average. And again, that was because of that 25% effect of one company that went way ahead of expectations in the last year. And in the financial performance of net sales revenue, you can see the Happy Feet Shoes was a little above the pack in years 11, years 12, years 13. Year 14, we were just very close. We were only just a little bit less, $5 million less than the industry average. But then we had fallen a little farther behind in year 15. And that just really showed that after I did that SWOT analysis after year 13, I should have just bucked up and changed that strategy right away so that I could maintain my market presence. I was just a little nervous because of the only 2 years left in the competition to make big changes, but I can see how quickly other people changed, and I should have done the same thing. Let's see here. Then I say in the financial performance, in the operating profit, again, Happy Feet was a little above the average in 11, 12. 13 was a great year, and 14 I was above the average. 15 I was at 66,419,000, where the industry average is at 74,672. So I had fallen a little bit back on that too. Looking at the ratio analysis, I did a detailed ratio analysis of about 20 different ratios every week before I started in business. And the reason I did that because I wanted to see what the trends were, to see when I should start making changes. And if I saw a ratio that was increasing for years 11, 12, and 13, then all of a sudden decreasing, it told me that maybe I should be making changes. And I didn't make significant changes, but I made some. And in the 3 of them that are marked on gold on the side here, in debt to asset ratio, interest coverage ratio, and working capital ratio, I felt I did better than the industry average. This is what Happy Feet shoes had 0.08 in debt to asset ratio after 5 years, and the industry average was 0.06. In the interest coverage ratio, Happy Feet had 91.99, where the industry average had 52.85, so we far exceeded the industry average in that one. And in working capital, I had $120,536 in working capital available, but the industry average had $102,876. And for some reason, I still felt uncomfortable about spending money, even though I had more. And I think it was just the lack of overall knowledge and experience in the game that made me want to hold on to my money longer. I think some of the industry rivals probably spent money on upgrading their facilities to decrease reject rates, or they spent more money on celebrities and marketing to increase their image. And those are 2 things I had a hard time spending money on. Our default risk ratio was less than the industry average. Our operating profit was just a little bit less than the industry average. Our return on assets was less than the industry average. And our net profit margin was just a little bit less than the industry average. Our price per earnings ratio was 12.44, and our total asset ratio was 1.14. Now, if you want to take a look at all the details that I had on the ratios, look at my final report in the, let's see, I think it's a figure C in the appendices. I've got all the ratio analysis for the 5 years separately, and I have more categories in this. And I could definitely see certain points in each of the ratios when the trend started changing, and that's when I really needed to make changes to my strategy. Let's see. If I looked at my individual ratio analysis, this was kind of interesting how I managed my expenses internally. One thing I noticed when I started playing the game, well, I took over the game in year 10, excuse me, the cost of goods sold were 57% for a manufacturing company. And as a 15-year veteran of economic development, I've looked at a lot of company financials, and that's really high for a manufacturing company because you have to double that to sell it to your wholesalers, and they have to double that to sell it to their customers, and there's a lot of marketing costs and things that come out of there. And so I was concerned about that to begin with, and I worked really hard on trying to decrease that amount. And you can see I ended up with a cost of goods sold a little bit higher than to begin with, but I actually had a much higher quality by that point. Instead of having an SP rating of 5 for the same product here, I had an SP rating of 7 in this category. So I felt really good about that. And the warehouse expenses, again, those are just costs of storing shoes. And so the better job you did at predicting the production, the better the more money you saved on warehouse expenses. So I did pretty well with that, except in year Year 14, I must have had an overage in some of my past years, and I had a high storage expense there. And in year 15, I brought it down again. Let's see, in the marketing expenses, that's something that could go crazy, especially if we had a big class with a lot of competitors. But in this class with only 4 of us, the 4 of us were pretty conservative spenders, and I thought that was actually kind of nice. And my marketing expense in year 15 was roughly the same as my marketing expense in year 10. And so I kept a handle on that and still increased sales. My average administrative expenses, again, I thought administration is just kind of money out the window. You want to spend the less as possible on that. In my former job, I always said I'd like to spend money on staff rather than stuff. And so administrative expenses tends to be a lot of stuff in the office. And so the year 10 administrative expenses were about 3.25, and the year 15 I brought that down to about 2.55, and so that was a lot better. My projections going forward, it's always good to look forward. In business planning, 2 years is normal. If you want to get a commercial loan, you better have 2 years of really good projections ahead of you. And they better be conservative in revenue, and they should be a little extra contingency and expense just in case. I've done business projections for many years for SBA loans and such. And so I looked at my existing sales, and I calculated my trend of the increase from year 14 to 15, which is 4%, and I used that to calculate moving forward. And so my net sales revenue for year 16 would be 380 million, and my net sales revenue for year 17 would be 410 million. And that actually is a little bit high even on the industry average. I know the BSG gauge said 8 to 10%, but that would be really unusual in a manufacturing company. They're more like 2 to 4% a year that they grow, and it's important because it takes a lot of capital to grow a big manufacturing company, so you better have enough capital available if you project high growth. I did the same thing with my operating profit as I used the trend from years 13 to 15 to determine my operating profit going forward, and I projected 20.63% in year 16 and 97% in year 17. And that was a little on the low side, basically because I wasn't sure how long I'd be able to constrict the internal spending and the marketing spending. My earnings per share, I projected at 5.28% to grow to 5.31%. And I always feel it's important when you're projecting external factors like shareholders might really care about earnings per share, that you project it a little bit conservatively so they don't get all excited about getting a lot of earnings per share and then go, oh no, we didn't get it. So I really felt that that was probably a pretty conservative estimate. And my return on equity, I kept it stable at 17.9. That's what it was on year 15. And I projected it to grow to 20.88 in year 17. The stock price, I projected a comparable increase to 76.07 in year 16 and 82.15 in year 17. Looking at my 5 forces of competitive strategy, this is kind of an overview. I felt it was a little bit subjective, and that's why I didn't use it in my new core presentation. But I used it here just to look at it as a graph to see now what I have to be concerned about in the future possibly. And the power of suppliers, I thought they had a relatively weak competitive effect on my strategy because we only had 2 different types of materials we used in our shoes. We used basic or we used superior materials. And in real life, suppliers, they could do deals with 1 or 2 different companies, exclusive deals, to get a lower price on the supplies and materials. And we couldn't do that in the BSG game. And we could, the suppliers could be much more competitive in real life, but we only had that one source of suppliers. So I felt that was a very weak competitive strategy in the BSG game. The power of buyers, on the other hand, had a very strong effect on my strategy because I found that the buyers were very fickle. They, if Oprah was my celebrity, a person, I did better with her than Tiger Woods. and it doesn't have any effect on the value and the quality of my shoes, but people are pretty fickle in the footwear business when they're buying. The substitute products I could use, there were very few substitute products that we could use or that buyers could use instead of my athletic footwear, because athletic footwear really spans management. There's a lot of people that have more of a dress footwear style. There's nurses, there's uh, athletic footwear that have steel toes, and then everybody uses it in their day-to-day life. I felt the threat of substitute products such as used footwear or another type of footwear like flip-flops would have a low effect on the buyers. The barriers to entry, I thought that was a weak effect on my competitive strategy because it's very expensive to start a manufacturing company. We started with $5 million of capital plus 2 facilities up and running and a workforce that was already trained. It would be very hard to replicate. Intensity of the rivalry, I thought that was an extremely strong competitive strategy because the 4 of us, we all wanted to win. We could tell we were good game playing families, and we really worked on strengthening our strategy, spent many hours on it each week. And the level of industry attractiveness, I thought it was pretty high because the industry on the whole is growing. Although it is hard to start a new facility, it might not take somebody too much if they have good capital and if they have good credit at a bank to jump into the business of athletic footwear. Let's see, the rival company comparisons. I thought this was kind of interesting because it was only 4 of us, but I compared with all of them. Good for the Soul. That's the one that concentrated on having high quality products, a low number of models, and a high price strategy. And that actually performed very poorly the first couple of years. So I was relatively scared of trying that because I wasn't sure that would grow. But she concentrated on that, and she did really, really well in the last year because it took about 4 years for that philosophy to catch on with the public. Brown Dog Shoes concentrated on low quality, high model number, and low price. She was the one that right out the gate, she lowered all of the prices of the shoes from year 10 to year 11 was significantly less. And it really set the bar for the rest of us. If we wanted to compete on low price, we had to really work hard on our numbers to get them as low as Brown Dog Shoes. And then Great Feats, when I looked at his market share and competitive reports every week, I found he concentrated on steady prices and steady market share. He really didn't raise his prices. He really didn't lower his prices, but his market share stayed really stable throughout the whole competition. Now, my closest competitor in strategy was Brown Dog Shoes because, again, we both found ourselves in the business of low quality, high model number, low price because we wanted the quick numbers when we got out the door. The closest competitor in sales was Good for the Soul because even though she ran the last year of the competition and did really well, her sales that year were 356 million, and my sales were 345 million. I just sold a lot more pairs of shoes, and I had a lot lower profit margin per product. But that was our closest competitor in sales, and closest competitor in score was Great Feats. Great Feats had a game-to-date score of 100, and Happy Feet had a game-to-date score of 101 at the end of the 5 years. So that's how we competed. Let's see, the strategy I would recommend going forward, and I really did learn a lot about this through this game. The grand strategy, I didn't have one when I started. I just had one basic strategy, and I saw that if you had a real grandiose strategy of growth, you want to increase market share more than everybody else, you want to increase at a faster rate than the industry, you really had to have a grandiose strategy and put yourself up to the challenge of meeting your strategy with your board of directors and with your management. My strategy in the grand strategy was a stability strategy. Just stay in the game, make a good living, and it will be fine, but I didn't enjoy that strategy after a while. I would also recommend having a corporate strategy that was in continuous product development. You continuously have to develop products with a higher quality and a better SQ rating so you can continually compete in the marketplace. I find that when I was trying to lower the cost of my product, there's only so far you can go. And so I did produce product development in the numbers of models, but I found that that was really hard to maintain. And so I would really look for higher quality, recommending a strategy going forward. And international strategy, you do that a few different ways. I use a global strategy, which is basically the same competitive approach in all 4 countries. But I found if I was going to be in this business longer, even in just a couple years longer, I would do a significant amount more research on the market in each country to see what the potential sales could be and what really made their sales happen. And then I would also research the tariffs and the duties and the exchange rates to really well place my production facilities and maybe change them to save some money in the transfer of goods. Business strategy, I say going forward, I'd create a strategy that said create the highest quality shoe with the most unique features that you can possibly afford. And my current strategy of a low-cost provider striving for overall lower cost than the rivals with a comparable product was really kind of wimpy in the end. Although I shouldn't be so hard on myself because I really did pretty well throughout the competition. But I think that's the challenge in business. You can always see yourself as bigger and better, and you have to be able to see that. How it evolved is I started with 200 models. I increased my breadth to 250 models, but I kept the SQ rating a little bit lower to limit costs. How it should evolve is I should develop fewer extra models, but I should really concentrate on that higher or more unique value in each of the models. Let's see. Now I have some long-term and short-term recommendations for strategy. And long-term, I would increase that SQ rating in footwear quickly. I would invest in corporate social responsibility quickly. Right at the first, I waited 2 years before I invested because I didn't see the results yet, and I had to play catch-up in year 14. It got me an award in 2 years, but boy, I had to move really fast to bring that image rating up. I should buy additional capacity. One of my rivals sold some capacity, and it just lay on the market for a year. And in hindsight, I should have bought that capacity right away to increase my capacity for private label shares because private label sales because I was really good in that market also. Repurchasing stock each year. I did it a few years to increase my return on equity, but I felt like, well, it's kind of cheap to do it every year, but then I found that my rivals were doing it every year, so I would do that also. And I would develop a challenging long-term strategy, and I would keep with it. Short-term, I would increase my accuracy of my production planning. I'd have way too much in overages, and then I would have stockouts because I underplanned the next year, and so I really would have to fine-tune that. I'd refinance my loans sooner. I found at the last year in business, I actually had a loan out there at 8.5% interest. And that's when I had a B credit rating, but I had an A plus at the end, so I probably could get a much better interest rate, and I could have got it sooner. I would minimize my dividend payments. This was kind of sad. I started over in year 11, and I noticed that the company had made $1 per year dividend payments to the shareholders in the years prior, so I just kept on with that because I worked for a board before, and I know that I don't want to shake their belief in the company. So just keeping with the same dividend payments made sense to me. But I noticed all of my rivals were making no dividend payments or very little dividend payments. And I probably could have saved some money doing that because I don't think it mattered so much in our image rating. And I would increase worker training early to minimize reject rates. I did it after year 2 or year 3, and I felt like I should have done it sooner. Now, I was really happy to have Kay Mack as my field representative because she has a really big picture overview and is not afraid of, share your overview with me, please. I have a very limited time. And so I was really happy she brought up right away the idea of tying compensation to the big picture. Sometimes we don't give employees the benefit of the doubt in knowing that their work really changes the world. And she suggested changing the production incentives to tie them with a nonprofit donation because it would build better production rates, probably give us fewer reject rates to make a donation that of the choice of the workforce, and possibly something that was related to Happy Feet shoes, like a third world country that lacks proper footwear. If the employees could see that Happy Feet shoes was taking the excess um, profits in the company and donating to something that really mattered to them, then they would work hard and they would see the big picture of their work, and they would see that instead of just seeing that the company is making more profit just because they're working hard. So let them participate in the global mission is what I learned, and it's a really strong lesson, and I will probably remember that for a very long time. We also had some discussions about using external partners, grad committee members from outside of the BSU organization, and having maybe a video explaining the game to them would be very helpful, because this is a very complex game, and it was really hard to explain to somebody in a very short period of time. A quick video on YouTube, 10 minutes saying this is what the game is, would have saved a lot of time, and she would have known what she was getting into before she agreed to it too. And then the grad committee, I think if we would have had more time to meet in person a few times, or at least at the very end, you guys would have bounced off really good ideas and had been probably more benefit to me as a student. But time is kind of tight and schedules are kind of tight. So that would be the 3 lessons I learned from my field representative. And to give an overall summary of the accomplishments, we had an overall game-to-date score of 101, which was 2nd place out of the 4. My rankings each year, for 2 years, I ranked in 1st place. For 1 year, I tied for 1st place. So 1st place, 3 out of 5. I really can't be too hard on myself. I thought I felt really good when I was done. The awards, I was in year 15, I was 1st place for the Corporate Social Responsibility Award. That felt good. And in year 14, I was 2nd place for that same award. And that's year 14 is about the time I realized that that was the only way I was going to get my image rating up, was made some significant investments in corporate social responsibility. So that's a lesson I will learn in the future also. Comparisons to the industry at the end, I had the highest amount of cash on hand. For good or for bad, I seemed like I was a little afraid of spending it, and that was the result. I think if I had more years in this business, I probably would put it to good work. And as an MBA candidate at Bemidji State University, my last big project, I say thank you very much for listening to this, and thank you, Grad Committee, for your partnership in this project. It really, really means a lot to me.